Hello class, this is Brian from financialtrainingschool.com and welcome to BO203 Part 2 using trend lines. So in Part 1 we were talking about connecting the dots, and basically when you're drawing trend lines this gives you a chance to be a kid again. Literally, because you're using trend lines to connect the lows or the highs together. So keep note, this is connecting the lows to another low and the high to another high. You're not connecting the highs to the lows together. You're not going diagonally, you're just going on the same side. So usually you focus on the lower trend line in an uptrend, which acts as support, and you focus on the higher trend line in a downtrend, which acts as resistance. Once you have your focused trend lines drawn, you create a parallel line to enclose the price on the other side of the channel. And basically what you're trying to do when you do this is you're trying to find the perfect fit on the other side. So think back to stats, the line of best fit. So you're trying to find a line where most of the points are on the line, so the most touches as possible. If a perfect fit is not possible, you create another trend line connecting the dots on that same side while keeping the original parallel line. If price breaks your trend line, be prepared for a change in direction via drawing new trend lines. If it bounces instead of changing direction, simply create a parallel line for this absolute high-low at the edge of your channel. And lastly, do not erase your trend lines until they are deemed useless, e.g. price never bounces off of them. Sometimes, personally, I just like to keep them on anyways, just to see if price pays attention to them in the future. So, just like SR levels, we will be using probability trading here. But the probability levels are different in a trend. The reason being is because it's always changing. Since price is moving in a certain direction, think about it, if price constantly moves higher or lower, your next entry won't likely be the same as before. The only way to get the highest probability is to stay as close to the edge as possible, i.e. to the trend line. Having said that, there may still be multiple levels in the sense of having drawn multiple trend lines, i.e. for the absolute highs and lows, then you have where the bulk of your channel is, so you have multiple levels in that sense. But stay as close to the trend line as possible, and I will elaborate on this later on in the last slide. And as you'll see in the examples, I have to use SR levels to illustrate breakout conditions. So basically what this does is it combines probabilities of multiple strategies together. So you'll have the trend lines plus the SR levels and the breakout conditions. So together, all of these things will resemble mini pattern formations within the trend. Thus, the more things lining up, the higher the probability will be. So for trade entries, these depend on the type of breakout. So you might have a news spike or a random spike, or you have a real trend. The spikes will be covered on the next slide, while the trend will be covered in the rest of the lesson. Basically, your first trade will likely be the breakout trade, referred to BO202 Part 3. I mentioned this inside there. So the breakout trade is your first trade. Subsequently, after the trend has formed, you'll be entering either touch trades or confirmation trades depending on the width of the channel. If the channel is narrow or sharp, don't bother with confirmation bounces because price will have moved too much by the time you get in. If the channel is wider, e.g. it takes a few moves to get from one trend line to the next, then a confirmation bounces are possible. So regardless of it being a spike or a trend, they both start off the same way. They have to break out first. Upon breaking out, the initial surge in price outside of the range should last a few candles before it runs out of steam. What follows afterwards determines what you're dealing with. So if it's a spike, like I mentioned before, you have news or random. News, basically, if you're a new trader, just be aware of the news release and avoid trading around these times. Because unless you've had experience observing the outcomes, you're most likely going to lose. So like I mentioned before in the BO202 videos, I think I mentioned it there for the news release, stay away from the markets between 15 to 30 minutes before and after the news release, because unless you have experience trading this, don't bother, you're most likely going to lose money. Then for random price spikes, this is basically when price just surges outside of the range and keeps going and doesn't turn back. This would be a breakout. An example of a random spike is when someone places a big order or fat fingers of trade, causing price to surge up faster and further than normal. And basically when this happens, the only good entry you have is the initial breakout trade. Otherwise, any trades afterwards is usually considered chasing. If you miss the trade, just sit out and wait to see what happens. And always remember, a missed opportunity is always better than lost money. I would much rather miss a winning trade than to take a losing trade. Because why would you want to lose money, right? You try to avoid the low probability trades and you stick to the high probability trades. And in a spike, the only high probability trade is the initial breakout. After that, you're just chasing, and that's just bad. Alternatively, depending on how much price retraces, also called a pullback, a trend could potentially form. If, after breaking out the initial surge, price retraces back to the previous SR level that broke out of the previous range, one of two things can happen. If it's a spike, then it might break back inside the previous range, and this is known as a false breakout. Or if it's a trend, then it might bounce off of the old SR level, since the role should have been reversed, because if it previously broke a resistance, coming back to that same resistance, it should now become support, and it should bounce upwards and continue the trend. So if price retraces back to the old SR level, or it only retraces a portion of the initial surge, this is when you should start drawing trend lines and watch to see what happens. So you wait for the pullback to finish. So let's say it's an uptrend, it breaks out, it goes up, you have a few green bars, then it pulls back a few red bars, and then starts going green again. As soon as you see the first couple greens after the reds, this is when you start drawing your trend lines and you wait to see what happens, because you're basically seeing if a new trend is forming or not. And basically the steps for drawing a new trend line is you draw from the pullback point to the previous low or the high within the range, with extensions in the appropriate direction. So if it's an uptrend, right, so you have that green breakout, then it pulls back red, and then goes green again. That low of that red pullback, you connect that low to the previous low within the same range before, and that's your initial trend line. And I'll show this in the examples. And basically, you need to be prepared to draw multiple trend lines when necessary, because usually step 1 is not accurate. For instance, price may bounce after the pullback but make a different low than expected from the initial trend line. So you need to adapt. So for the next slide, we'll be covering the characteristics of a healthy trend. So basically, a couple things to keep in mind here is what goes up must come down, and nothing moves in a straight line. Pullbacks are healthy and necessary for a good trend. Period. That's it. End of discussion. It must be there. And this is just my own opinion, but here's an ideal textbook perfect trend. The initial surge should be 10 to 25% in size compared to the old range. So if the old range was 40 pips, 10% would be 4 pips, 25% would be 10 pips. So 4 to 10 pips for your initial surge is okay. After it surges, it should retrace back to the previous broken SR levels, and then it starts moving onwards. So while in the trend, if you draw fib lines, refer to BO201 for this, between the highs and the lows, the pullback should retrace up to the 50 or 61.8% fib level before moving on. So here are the critiques for this. A large initial move makes it look more like a spike than a new trend. And then a pullback early on usually gives it more strength in the long run. In addition to the fib levels, the time it takes to trend and pull back should be a reasonable time. This is a very subjective topic, and this usually results in a good angle. Personally, I hate geometry, but this is the only way I can be specific, since shallow or steep slopes is kind of vague. Like, what's steep? What's steep to me might be shallow to you, or vice versa. So everybody has their own opinion of this. So the angle of your trend lines are dependent on how far you're zoomed in or out. Also, different time frames play a role as well. A 5-minute trend line will look different from a 15-minute trend line. So depending on what time frame chart you're on, they may look different. If I draw a 5-minute trend line and then I shift to a 15-minute chart, it's going to look different. So here's a breakdown of the angles. Again, just to remind you, this is completely my opinion. There aren't that many people talking about this online, so this is just from my own personal experience. And this is the only way for me to get technical here. And for the technical people, these numbers are only for uptrends, since these degrees belong in the first quadrant. You need to adjust them accordingly for downtrends. So for downtrends, you're working in the fourth quadrant. So between 0 and 30 degrees, this is a slight uptrend, and it's relatively flat. So you can almost treat this the same as a range. Then between 30 to 60 degrees, these are the ideal trends. So between these angles, this is what you typically want your trend to be found in. Exactly 45 degrees is a perfect trend. Okay, this is perfect. 45 degrees is not too flat and it's not too steep. It's just in the middle, so that's good. Between 60 to 75 degrees, you're starting to get into spike region, so you have to be more cautious here. 75 degrees and higher, most likely it's a spike, so trade carefully. Treat these as guidelines because there will be exceptions from time to time. So lastly, before we get into the trade examples, when possible, try to follow the trend. If it's an uptrend, focus on placing trades on the lower trend line for calls off of the support, and vice versa for downtrends. Try to avoid counter trending because it doesn't always work. E.g., it may be tempting to place puts off of the higher trend line in an uptrend, but the higher trend line doesn't have the same probability anymore, despite it being in the edge. Because what happens if price suddenly spikes up? Maybe it's going to break the higher trend line and just spike upwards, since it's an uptrend anyways. These things are random. You can't stop it, but you can certainly avoid it. You can counter trend at your own risk, and I will show these counter trend trades for the sake of examples, but be aware of the risk. We're just trading with probabilities here, so better play the high probabilities than to trade the low probabilities. So, on to the chart examples. This is USD CAD on the 15-minute chart, and the reason why I'm using 15 minutes is because I want to show you guys starting from last Friday's data, so right before the market closed, so that if we draw trend lines on Friday, they do continue to be used at the beginning of this week, and then we start changing trend lines as we go along, just to show you guys that it's good to keep your old trend lines on the chart so that you can transition from week to week, because the first couple of days of the next week will be used from the previous weeks, and so on and so forth. That's usually how the markets work. So we are starting from, this is Friday midnight, and this is AM. I don't have the mistake this time. So this is the morning of Friday. This is the whole Friday, and then we're going to go onwards into the weekend on Sunday evening, and then we'll move forward from that point. So one thing to do before we start is I just want to change the settings for the trend lines so that we're creating extensions. So you want to extend left and right, and we're just going to show the blue just for the sake of showing that the extension bounces versus the trend line bounces. So black is where the initial trend line is, and blue is the extensions. And you want to extend it left and right. It doesn't really matter about the left side because we're moving to the right anyways, but it's just for the sake of whatever, right? The other thing to note is you should only be looking at 12 hours, so we will be zooming out for the first couple times because I want to slowly move from the 15-minute chart down to the 5-minute chart, but 5-minute chart only displays up to Wednesday's data, and 10-minute chart only displays up to Monday's data. So we need to stay on the 15-minute chart for a while, so that for the first 10 minutes or so, we're just going to be zooming out, and then once Monday starts, we'll start zooming in again to 12 hours, and then we'll start going down through the time frames. So this is the morning. I started at this point for a reason because we can see that a trend is starting to form, because here you have, say, this is a resistance level, and then it starts breaking out, right? So if you wanted to trade the initial breakout, a trade somewhere within the initial time frame would be nice. Well, we're not focusing on this because this is all in hindsight. We want to focus on what's coming in the right side. So this is just to show that the initial breakout, and this is the first pullback. So it goes up for a considerable amount of time. So this is between 7 a.m. to 9 a.m., 10 a.m. before it starts pulling back. So it's quite a long time. This is the 15-minute chart after all. On the 5-minute or 10-minute chart, you might have pullbacks, but the data doesn't show on free stock charts to show this. So we're just going to assume that this is a spike to start off with, right, for this trend, and then it starts pulling back, and then at this pullback point, we draw the first trend line. And you want to create a parallel line, and then you drag this to, say, the top like that, because this is the top and this is the bottom. And then basically now we see what happens in the future. So I'm going to zoom out for the first couple of days until we get to Monday trading to see what that looks like. So we're not placing any trades until it touches the trend line, basically. This one, the top here, you can see here at the top, it doesn't look like it's forming up there anymore. So you want to just create a parallel line again so that you can go into the middle like this. So that you have different channels. Initially you have this bigger channel, but now, given price, it looks like it's stuck within a smaller channel. In the future, it might continue to break out. You don't know. But you don't worry about that. You just draw them as you see it. So zooming out, zooming out, zooming out, up to around this point, it's really close to your trend line. But for the sake of examples, we're not trading until the Monday point. I don't want to get into the trade examples until Monday, where we zoom into closer time frames. Here is just to show you guys that old trend lines do play a role in the future. So at this point, you see it breaks this trend line. What you could be doing at this point is you could create new trend lines based on what happens next. So let's see if it goes up or down. So at this point, this pin bar here looks like it's going to go up. And am I zooming in or out? Out one more, and it does go out. So what I want to do is basically create a new trend line up to that point, so that in case it does come back to it in the future. So you go from this low to that, and you might also want to make another one from this low to that point. This is what I meant about being creative, because as a kid you just gotta be, where are the dots? Let's just connect all the possible dots to see where the trend lines are. Basically, that's the mindset you want to get into. So we're just gonna keep zooming, because this is now Sunday evening. We're not trading until Monday in the morning. That's when I start zooming in again, and I start using the 10-minute chart. Zooming out, zooming out, zooming out. You can see how this old trend line from before is starting to act as resistance up here. So it's kind of sticky, right? So this is, price is sticking to this trend line. It wants to break up, but it's kind of hard. And this is also to illustrate the point of, you don't really want to trade puts in an uptrend, because look, it's sticking to this, which is acting as resistance. So technically you'd be tempted to trade puts, but it's just continually going up. So that's kind of risky. So you don't bother with those. I will show them later on, but not now. But just to illustrate the point that it's risky to counter trend. Zooming out again. And now we are into Monday. So this is Monday, and this is the point I want to get to, is here at Monday you can see a trend line that we drew from these previous lows here. It does pay attention here. And maybe in the future it will again. So let's just zoom out one more time. In the future it stops. It doesn't become resistance anymore. We're just going to erase these lines now. But this is just to illustrate the point that if you draw trend lines from your previous week, they might be respected again in the future. So here this was resistance, and here it was support. So I'm going to erase these lines, and then we're going to zoom into the 10-minute chart. And 10-minute chart is basically going to start on Monday at midnight. So to erase drawings, click on drawing right here under the time frame selection. Drawings, delete all drawings. That's the easiest way to do it all. Click OK. Now I'm going to switch to the 10-minute chart. 10-minute chart, we're going to zoom in to somewhere like that. I want to zoom into 6 hours at first. So this is Monday at midnight a.m. right? And you can, this previously the trend line was touching this point. This was the support level down here. So right now what I want to do is something like this. Draw a trend line like that, and I want to create a parallel one, because after some experience you can tell where the lines are. So you're just trying to find a line of best fit. You might want to draw multiple of them if you want to, so just to have multiple levels. And then maybe another one up there like that. Right, so something like that. This is the beginning. So I want to zoom out to the 12-hour mark, and then we're just moving forwards at that point. And this is a 10-minute chart. And then we'll be moving forwards until the until Wednesday, which will then switch to the 5-minute chart. Or maybe we'll just keep 10 minutes. We'll see how it goes. So moving forwards, we are placing trades now. So we're now in the trading mindset. So this is 6 a.m. until it gets to 8 a.m. 8 a.m. is then U.S. session, and then we're looking for 15 or 30-minute trades. But since we're on 10-minute charts, let's just, for the sake of simplicity, trade 30-minute expiries, and we're only entering before the we're entering at the 20-minute mark, because technically it would be 25 minutes because 5-minute lockouts, but we're just going to enter at the 20-minute mark just for the sake of whatever. Zooming out, so you can see up here starting to become resistance, right? So if you wanted to, you could place puts every time it touches up there. So if you wanted to, though, we're assuming that we only trade for 30-minute expiries. So this one right there would be a put on that trend line, drawing from these previous levels down here, because I just drew different probabilities. So one for the absolute high there, one for this middle high here, and one for the lowest high here, and this one happens to be up there, so you'd place one trade, and this would win because this is a 30-minute expiry here. And then after that, it doesn't touch. Up here, this is the 30-minute mark, so technically we're not entering yet. So you could wait if you wanted to, or you could enter the next one at the open because it's near here. So let's say we enter the next candle for the 40-minute mark for the end of the hour, just to see what happens. So we're zooming out again, and it does end up winning, right? Okay, this wins. And see, this is the problem with zooming out because it zooms out 1 hour, so this is kind of hard. So we're not at this point. This 10-minute mark, you would place a trade again, and we're just gonna take that loss because for the sake of consistency, we are trading this trend line right there. So we do place this trade, and we do lose it because of that. I don't want to cheat in saying that we zoomed out and then we're gonna avoid the trade because we saw what happened. So that's kind of stupid. We're trading this trend line, so despite zooming out and we know it's gonna lose, I'm just gonna count it as a loss for the sake of consistency. Now you need to see what happens. Is this a breakout? Is this a spike? Is this what's going on? And something I forgot to notice, we forgot to check the news. So checking the news. So this is Monday, right? So this is 23rd. 23rd, we are looking at the 8 a.m. mark. On Monday, we didn't have news until, so basically no news to worry about until the evening, or unless you talk about this one. Mainly don't really focus on news until, since we're playing the Loonie, focus 8:30 is on Tuesday, and yeah, mainly Tuesday. Wednesday has some news. Thursday got some news there for US, but yeah, not that much news. So let's just see if this is a new spike. So this is not a new spike. If it is a spike, it's probably a random spike. So at this point we're watching, unless you want to trade the initial breakout, right? The initial breakout would be this breaks out, this pulls back, you place a call right there at the 30-minute mark. If you wanted to trade the initial breakout would be right there at the pullback, because potentially this is what you're doing now. You're drawing a new mini trend. And this, looking at the angle, this is looking at like a 60-degree angle. If you were to draw, let's just imagine a protractor. So this is a makeshift protractor, right? So this looks like it's about 60, maybe 70 degrees. I don't have a protractor. You can't put a protractor on the screen, unfortunately. But this looks like, I'm guessing that would be 70 degrees. 70, 80 degrees. So this looks like a spike. But if you wanted to, this touching all of these lows here, this trend line, this is actually a trend line bounce on this spike, but this is also breakout trade. So that's double probabilities. So let's see what happens. This is going to expire for the 9 a.m. mark. So this is placing the trade at the end of the 30 minutes. So let's zoom out. And what do you know? Look, it spikes up. And it wins. And I didn't see that. Okay, I didn't zoom out to see that. We placed it before I zoomed out. So, yes, I did. You could say that before picking this chart, I knew there was a spike coming out. Yes, I did know there was a spike coming out. I just didn't remember exactly where. But this is good. Okay, this, at least I tell you the reasoning beforehand. Looking at the angle, see, look, as soon as I zoomed out, the angle changed. You notice that? If you zoomed in, this looked like an 80-degree angle, right? Or 60 to 70, 80. I don't know what the hell the angle is. But this looks like a steep angle. As soon as you zoom out, it just becomes a 45-degree angle. Or this is maybe a 50. It's a slightly shallower or flatter angle. Or acute angle relative to the other one. Right? So, just to show that different time frames, different zooming out gives you different angles to look at. And previously before, these look like relatively steep angles, right? See, these were kind of, this is more of a 30-degree angle or something. As you zoom out, they become flatter. This is now less than 30 degrees. Maybe it's only 15 degrees, something like that. Right? So different time frames have different angles. So as it spikes, so this one is just a big no-no. This is a random spike here at the 8:40 mark. I'm guessing news came out at 8:30, but nothing. I don't see anything, unless I'm looking at the wrong date again. Am I on the right time? Okay, this is 8:30 a.m. on Monday, 23rd, no news. So something must have happened. This is a random price spike. So random price spike, you basically don't watch it. If you got the initial breakout trade, which we did, then you get in. See, because afterwards, it doesn't pull back. If you get in at the top here, you're going to lose. You get in somewhere in the middle, maybe you might win. So on a 5-minute chart, it might pull back in the middle. You might win there. But otherwise, it's just chasing. So you just avoid this altogether. So at this point, you're just watching. Is it going to obey this trend line here? Since we zoomed out too far, I'm not gonna bother trading it. But moving forwards, so now we're actually at the 11-hour mark. So at this point, I'm just gonna start scrolling forwards rather than zooming out, so that we don't zoom out that far. So what I want to do at this point is we're just gonna watch, see what happens, because it goes up, it starts consolidating, starts moving down. You can start drawing new trend lines here if you wanted to, something like this and something like that, so that if it comes up to here, you might want to place a put in a downtrend. So moving. So now back to this point. Now here's the funny part. As soon as it touches here, you're wondering if this is a start of a new trend, right? Then it would bounce. But initially, the first trade, usually you just watch it. But if you are a risky trader, then you could place a put right there. And this is for the 15-minute mark, so you'd still have an entry. See if the next one bounces or not. If you are a risky trader, you take that trade because it's a touch. So previously, these are resistance. It breaks it. Coming back down, it should become support. But given this price spike, not likely, because this is a spike. It's not a trend. This looks more like a spike than it does a trend. A trend would go up to here, and then would bounce back down, and then go up. In that case, if it was here, I would place a call. But here, kind of risky, but for the sake of examples, we can place a call there just to see what happens. So if the next bar is green, we win. If the next bar is red, we lose. It loses. So this is a loss. So now at this point, you're questioning yourself, okay, maybe this is a spike, although we already concluded that, and you would avoid trading if it was a spike. Spikes, if it spikes up, you're expecting it to come back down inside here. So we're going to avoid placing any trades until it comes back down here for support, or if it comes back here again, if it enters, you might want to trade a break-in trade. So this is kind of similar to breakouts, except breaking out, you're going outside. Breaking in, you're going back inside the trend. So going back inside the trend, you may want to, depending on what the next bar is, or even at the close of this bar, you may want to, since you lost that one, you might be on tilt or whatever, but you might want to place a put right here at the end of the hour so that it's a break inside the old trend. So let's just scroll forwards one bar, see what happens. So it's breaking back inside now. If it wins, so this is at the beginning of the hour, right? So if it expires at the 30-minute mark under this trend line, then we win. And if it comes back down here at the 20-minute mark, we will place a call. Moving, doesn't come back, but we do win that one. So this is now back inside. So now you need to see what's happening, and see this is the first pullback after all of these reds. So now in your mind, maybe it's forming a new trend. You need to do this all the time. So you need to form a new trend line. So this one doesn't work, it breaks. So you pick a wider one. So you say pick it up to there. And so after you draw that one, now we're just watching and see what happens. And maybe you want to create a parallel line so that you draw the bottom, something like that. So that if it bounces down here at this cross here, that would be a good trade up. So let's move forward, see what happens. Moving. This point is a 50 mark. I would want to trade a put right there. It touches the trend line. We're just trading 30 minutes expires it like before. And at this point, you might want to erase these useless ones because it's never going to, at this rate, the price is not going to touch any of these trend lines again. So this is gone. This is gone. This was just for the protractor. Gone. These ones might come into play in the future for resistance. Maybe, maybe not. We'll see what happens. This one potentially could still be forming. We'll watch it, see what happens. This one, if it expires that the next bar is red, then we win. And it wins. So far so good. This is why I like trending markets rather than ranging markets, although they're both easy once you know how to draw the trend lines and all that stuff. So it's great. We have multiple probabilities up there and multiple probabilities down here. So at this point, you want to create parallel lines since you don't see it crossing down there anymore, just so that, let me just move this up there like that, and we'll create another one for a line up there like that. This is a very low probability line. This one's low probability because this is this is near the middle, so I wouldn't trade that one. These two for sure, those three for sure, but otherwise, don't bother with the middle one. It's just there for illustration purposes. So moving forwards, see what happens. Moving. I moved too much there, But basically this one we would have placed a put anyways, despite seeing that next bar. We would have placed a put there. And if we lose this one, that's fine. I just scrolled an extra one too fast. So the next one is probably going to be green, I think. No? Red. Okay, well this one lost. So now at this point you might be questioning this trend line, although you did win a few times. Moving forwards, moving forwards. See, at this point, since you lost that one, you would just avoid this trade. Considering, even though we saw this, you would avoid it. Although, this potentially resistance, but you don't know, you just wait for it, see what happens. Because this has only had these two bounces there. This one kind of acted as resistance there, kind of acting as resistance here again. You don't know, you just wait, see what happens. This one, at this point, I'm just going to erase this one, because we're never going to see price go down there. Moving forwards. Ah, look at that. It bounced off that one. Even though it did bounce, I don't want to place a trade because this is in the middle. This is just for illustration purposes. If this one bounces again, the next one maybe I'll consider it. But otherwise, no, I'd rather avoid it. Moving. It does bounce. So this one would have been a win, but we avoided it. So now we're moving forwards. Now we want to see what happens with this trend line. Is it going to bounce down like it did here and it did there? See what happens. But this is counter trending because this is a smaller downtrend compared to your bigger, longer time frame uptrend. Although this looks more like a range because the degrees isn't. It's kind of shallow. It's not that steep. So this is a longer term uptrend though. So it's more likely it's going to be going up than to be stopped by this level right here, which is only 5 pips away. So moving forwards, it breaks it. Look at that, breaks. I'm going to erase this one now. This one at this point I would place a put. And you can see comparing this to SR levels, we're more aggressive here than over there because here a trend usually yields more results, and up here all of these puts here technically are counter trending. So this is just for examples, but if you wanted to, you could be trading these. So let's see if this one expires at the 30-minute mark for a win. It has to go down. It doesn't go down, so this is a loss again. And this is now the third time this is a loss. So far now we're looking at 4 out of 7. So this is pretty much break-even trend line now. So given these many losses, I would start avoiding this lower trend line and start focusing on the higher trend lines. Higher trend lines, given this past action of all this stuff up here, this confluence here, 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 here again. This one's the 30-minute mark. What I want to do is I want to place a put at the close. Doesn't really matter at the close. You would like a pullback actually, so let's just say we place it at the close, and the close is actually the middle trend line, so that's decent. Otherwise the higher trend line is only, what is the difference? The higher trend line is 80, the middle trend line is 8.5, and the lower is 7. So really it's only 1.5 pips difference between them, so it's not that big of a deal. But if you get in here, that's a loss. And you notice how your entries are always different. Here we place puts down there, here we're placing puts up here, because in a trend your entries are going to change as you go along. So let's move along, move along, move along till the end of the hour. Do we win? Yes, we do win. So this is a win. So at this point I want to erase, or I'm going to change the color of this one to orange, just so that we know it's an orange line. We don't want to place that one. This one, kind of okay. This is kind of okay. These ones, we're just going to change them to green, just so that's easier to remember. Green, green again, and the top ones we'll place as red. And this one is still in effect, hasn't been broken yet. See what happens moving forward. Up here there's going to be a cross. This is going to cross down, and it's going to cross one of these trend lines. If it can hold it down, that would be a double high probability trade. So that one I would trade it. Moving, moving, moving. See, it crosses. As soon as it gets below that point, I'm going to raise it, because we still have our trend here. Moving, moving. It crossed. Hasn't done anything yet. This point, this is in the middle. I wouldn't place a put here. If you were risky, you could place a put based on an old trend line, but I wouldn't bother. I would just erase this at this point. Or we'll leave it on for the next hour, but then after that, we're going to raise it. But I wouldn't place a put here. Some people, if you're short-minded and you only look from this point onwards, then you would be trading it. This is the problem with zooming too far in. You would be only looking at short-term. So short-term, this is a good trend line. But long-term, it's not a good trend line. So I would avoid that trade. Let's see if it goes up or down. It does break it. And it breaks up there. Here is where I would place my put. Although, it's kind of, it didn't touch the middle. But, yeah, actually, no, we're not going to place a trade, because that's technically, it didn't touch the middle. So it was 0.4 pips off. So 0.4 pips isn't actually that much. So let's just say we got impatient, we placed that trade. And you can say I kind of cheated, considering I saw this pin bar. But you don't know what's happening. So this one, we'll leave it on there just to show you guys that it's not that good. Next one, what happens? Goes down, down, and down. Okay, so this one's gone. This trend line's gone. And with this, just proves that this is a spike. This one, it's starting to get down here. If it gets down here, I would place a call. I place a call down here. This one won by mistake from knowing what this 10-minute bar is. At this point, we're still in the Monday mark. So until we get to Wednesday, that's when we're switching to the 5-minute time frame. Let's just move forwards. It does get down there. Actually, it doesn't actually touch, but it does get close to it. So let's just place a call. And we need the next two candles to close above. Closes down. And wow, look at that. It closes down and it bounces back up at the end of the hour. So we win that one by fluke. But since it broke down to there and it's still held, it's still pretty decent. It's a decent level. So going forwards, they're both decent levels at this point until they're broken. Moving, moving, moving. So basically, we're not placing trades because we already placed a trade there. Unless it comes back down again, we place a trade, or against it goes up there, we place a trade. Otherwise, in the middle, don't bother. Moving, moving, moving. That one right there at the 5 p.m. mark. I don't recall there being news. Nope, not yet. It breaks both levels, but this is, this is at the end of the hour. So you're not placing trades regardless. And this is also Asian session now. This is right when US session is closing their aftermarkets. So you would avoid trading. You would avoid an entry, since if this one closed at the levels, then you might consider an entry for the next bar. But since it broke both of the levels, now you're just watching, is this another spike? Because look at how big this bar is. This bar is the length of this whole range, technically. If you look at it, so this is 87 down to 74. What is that? 13 pips. The range is between 63 up to 81. So that's, what is that? 17. So this is about 80% of your range. So no, that's a big spike. So I just avoid trading. And this is 5 p.m. So I would just avoid trading. Really, the only good time to trade from this point onwards is from 8 p.m. But let's just keep going forward, see what happens. Is this another spike? Spike, spike, spike. Is it spiking? If it comes back down to here, you might consider call. And based on my explanation before, the initial surge, right? There's two ways to interpret it. You can interpret it as this one bar as being the initial surge from within, or you can consider how much outside of the range did it go. So technically, from the outer band to 83 up to here, it only went up 4 pips. So 4 pips relative to 17 pips is 25%. So this is a decent outside break. So maybe it might be a trend. If it is a trend, then you would be following something like this, right? So this low, and that one connects there. Maybe if it goes up from here, then that would be your new trend if it forms. But let's just go forward, see what happens. We're watching. If it bounces, up from this point, then that could be a new trend. If it doesn't, if it bounced back down, then that's just a spike again. Oh, looks, it goes down. Still looking, watching. Don't do anything. At this point, this is not the line that you're looking at. This one goes down to here though, and this one becomes support. At this point, I'm just watching again. Although if you were a risky trader, like back here, where we had this breakout, and then here we would place a call, you could place the same call over here. If you placed it within the 50-minute mark. Well, actually, no, this is Asian now, so we wouldn't be able to place trades here. For Asian, we're only placing trades at the 10-minute and 40-minute mark, since we're on the 10-minute bars. We're not on 5-minute charts. If we were on 5-minute charts, you could be placing trades on the 15 and 45 minutes. So in this case, we're only placing trades 10 and 40 minutes. So this would be no entry, but it does bounce, so that's curious to know, watching the keeping forwards. But basically, given that we traded from 6 a.m. all the way to 4 p.m., and considering we got 1, 2, 3, 4, 5, 6, 7, 8 out of 12, 66%, that's a win. It's pretty decent. That's already 12 trades for the day at this point. At basically, as soon as market closed, you would consider to go take a nap or something, or go make dinner, because it's now 4 p.m. So moving forwards, it bounces at that point. You need to see what happens. It comes back down. Watching it. Does it go back inside? It goes back inside. So this is a spike again. Random spike. This is the end of the day spike, I guess. So moving forwards, this is now, I think we're like 40 minutes into the video. So we'll do another 20 to 30 minutes and then we're done. So I really want to fast forward at this point to the Wednesday mark so that we can zoom into the 5-minute chart. So we're just going to go slightly faster now. In the middle here, here's a potential trade there for a put. Right there. So depending on which line, we're just going to say in the middle at the close of that bar. This is at the hour, so we can enter. We're going for the 30-minute mark. Let's see if it goes down or not. It does close below. So this is actually 8.6 to 8.55. We're going to call this a break even. So that was break even. Moving forwards again. Just keep going back up. We're just going to keep placing puts. This one, this time at the middle line. Well, this one was at the middle line too. But anyways, this is slightly higher. This is at the 8.67 level. Does it go down? Does it? Yes, it does go down. So that wins. And yes, I kind of scrolled too far ahead there, but I didn't look at it, so don't worry. Moving forwards, see what happens. So this one goes up to the middle. So this one, this orange is kind of just ignored at this point. But at this point, you need to go, something to consider going through your head is, I'm just going to zoom out for this. Where are we up to? We're up to there. Look at this. This trend lasted. See, this is why zooming out is nice. This trend lasted from Monday, midnight, all the way until here, Monday, or near Tuesday, the next midnight, right? So this has almost been, what is this, 22 hours at this point? That's a long trend. Trends don't last forever. Nothing goes up straight, nothing whatever, right? You need to keep in mind for change. There's transitions to come up. So basically, you would be careful, be wary at this point, because it's been a long time, this trend. Maybe eventually at some point it's just going to change direction or start consolidating. But so far it's just been going up. This is why zooming out is nice. You can see how all the peaks are and how the lows are and all that stuff. So let's just zoom back into 12 hours and zoom forward to this point. Well, where is the 30-minute mark? 30-minute mark is there, and that is a loss. Right, no wait, I said 8.67, right? Or no, the high was... What entry did I say? I don't remember. This looks more like a break even though. I don't remember. My short-term memory is acting up. So, I would consider that break even, because that's like right near each other. The close of this candle to that candle is less than That's 0.2 pips. So 0.2 pips is I'm gonna consider that break even rather than the loss. Moving forward. This one. See, that's why at this point you kind of get wary of what if it's actually acting as resistance, because you got 2 break evens already. So kind of tempting to not even bother trading. So let's just say at this point it's been too long in the trend, and I'm just gonna scroll forwards for a day, just so that we can get to Wednesday and skip to Wednesday. But we're just gonna leave all this on here just so that you can see how markets move. So we're just gonna zoom out to Wednesday. So we're just gonna fast forward. I'm just gonna skip Tuesday trading altogether. So far for Monday, you have a total of 1, 2, 3, 4, 5, 6, 7, 8, 9 out of 13 on Monday, and you have 2 break evens. So that's pretty decent. 9 out of 13. What is that on the calculator? Let me get my calculator. 9 over 13 is 69.2%. It's pretty decent. 69.2%. That means you're depending on what trade sizes you're on, that's pretty decent profit. That's about 10% higher than break even. So for sure you're making money. But we're just gonna leave these lines on here, and we're gonna skip all the way to Wednesday. So we're skipping Tuesday altogether, because Tuesday is kind of hectic with news in the morning. So we're just gonna skip all that. But just pay attention to these trend lines if they pay attention again in the future. These bounces you can see here, if you wanted to trade them, you could be trading them. This is 210. That's a valid entry there. This is 310. Valid entry again. But we're not going to do that. Don't bother with it. Here, in hindsight, you can see this is a 3 o'clock mark. So at the end of the hour, you could be placing that. Actually, no, you would not be placing that trade. This one, though, 3:30, nope, not again. This one, 3:40, you would lose that one, though. But this is also news. So this is around between 3 a.m. to 4:30. You see a bunch of news. So you would avoid trading until 5 o'clock. So going until 5 o'clock, scrolling, 5 o'clock. 5 o'clock, now you see this stuck here, trend price is stuck there, so this is the break-even area. If you place the trades, you most likely break even. But we're just going to scroll forward. We're avoiding this whole day of Tuesday. Where does Tuesday end? Come on, hurry up. Tuesday ends right there. Tuesday ends here. So basically what I wanted to show was, this is most likely news. This is 9:30 something. So you get news around 8:30 to 10. You get US news. Although this is orange data, it's not red. Only this one's red. Core retail sales. So core retail sales, this is probably the one that moved everything. At 8:30, where was the market? 8:30. So 8:30 it goes down. Was this a green data? This was green. So yes. Okay, so it should have gone down. Because good Canadian data means the Canadian dollar is strengthening, which means the USD CAD goes down. So that's plausible. Goes down, it breaks your trend lines, which is expected because news is expected to do that. So it breaks that, and then it goes back inside. So this looks more like a news spike rather than a trend. The Canadian data isn't strong enough because you have US data coming after that. So Bernanke probably said something on Tuesday. I wasn't paying attention on that day. So Bernanke probably said something causing the markets to move back up. Probably mentioned QE3 or some bullshit like that. All that money flowing to the markets, which I will make a video in the future in the economics section to talk about inflation and all that QE printing, quantitative easing. So anyways, at this point, you can see how so this is actually a real breakout. So Bernanke must have really said something, because Bernanke caused this to happen around when did he speak? He spoke at 8:45. So 8:45, his meeting probably ended around 9:30 or something like that. His meetings usually last about an hour. So 9:45 is really when it ended, and that's when it starts going up, and it lasts for this is between 9:30 or 9:45 until 12:30. So that's what, 3 hours ish. 3 hours uptrend. If you were to trade this, you would be doing something like this, right? But see, this is the initial spike, and you got to pull back and then you spike. And this, based on the zoomed in angle right now, this looks more like a 60-degree angle. But if you zoomed in, then it would be slightly less. So if you zoomed in, this would actually be 45-degree angle. So depending on how far in you're zoomed in, it might be different angles. And you'd be okay, if you place a call there, you'd lose for the next one, but then you'd win later on, and so far and so on and so forth. You move them accordingly to whatever trend line. But I just want to show this for the sake of examples. If you move forwards, you can see how resistance trend lines before become support here, and then here it starts breaking back inside. The 25th is Wednesday, so we're gonna move to the 4 a.m. mark, and then we're gonna go back into the 5-minute time frames, and then all of this stuff will be gone, and then we'll be erasing them. So moving into the 4 a.m. mark, 4 a.m. is right there. At this point, you can see it's breaking back inside, and basically you're making transitions all the time. But up here, you can see how up here there's a trend there like that, right? Creating a parallel line, you can make lines kind of like that, so that these peaks become those lows there, or you create parallel lines down here after you get them, and you just keep doing that, and you place trades accordingly. This is fast forwarding because I want to get to Wednesday, but I hope you guys get the point that you just have to adapt to markets. As soon as you get new points or new dots, you just draw new lines and you see what happens and you trade them accordingly. First trade, if you don't want to be risky, you wait for the next bounce. The more bounces you have on a trend line, the more likely it's going to be a good trend line, the higher the probability will be, because you have unconfirmed touches and you have confirmed touches. As soon as you make one low, you touch it. The next low, you make another touch. The next one, you trade it because it's double bounce. Otherwise, one touch, like here, you could trade that one for a second touch, and then up here for those touches, etc., etc. You just keep doing it. Here, entering into Wednesday, is you see a slight change in the markets. You see this trend line here now, and creating parallel lines. That actually would be the middle, and you create another one, and that would be another one down there. So entering Wednesday, we see a downtrend forming because you're breaking into this old trend, and we were breaking down as well. And we're just going to create another one, something like that. So at this point, it's about 50 minutes into the video now, and basically I'm going to stop the chart examples here because I actually went ahead and I continued on to the transition to the 5-minute charts on Wednesday, but I edited that stuff out because it basically takes about 10 minutes to set up the initial trend lines for 5-minute charts on Wednesday, and then it's going to take another hour to go through all the examples there. So I'm not prepared to make a 2-hour video on trend lines. I would rather save that content for the next video, BO204, because that video will combine SR levels with trend lines and will do the whole big picture all together. So I'd rather do it there rather than have an extra long video on trend lines. So that's it for chart examples. I just have one final slide before we move on. So some final thoughts before we end off. Nothing continues indefinitely. The market is dynamic and it's not static, so you cannot be rigid. You must be subjected to change. You need to adapt when necessary. You need to be ready for that transition from mindset A to B. You need to go from ranging to trending to ranging to trending, because you need to have different strategies for different markets. And that's what BO204 is. BO204 will be the combination of BO202 and 203 together into one cumulative summary. Now that you've learned SR levels and trend lines, you can combine the two to help you determine the market type. BO204 will be the third and last PA technique video. Then BO205 will be the first of many factors affecting price action, covering the pattern formations. I'm not sure if I want to revamp that video or just use the old videos from the old series. I'm not sure yet, because basically all of those videos are basic. I don't have anything revamped because I think they were done fairly well, but that will be determined later on when I do the videos. So that's it for this video. My recommended brokers, as always, is 24 Option, Bank to Binary, and Trade Rush. Make sure you guys use my link to sign up so that you can get an hour of tutoring with me. Full details can be found at ftstutor.com. Hope you guys enjoyed this video, and I will see you guys next time.